This is going to affect, from my perspective, potentially everybody. It's going to affect the stock market in a big way. It's going to affect the credit markets. It's going to affect access to credit. It's going to have a massive negative impact on real estate. So, it doesn't matter. It's going to touch every asset class when this zombie apocalypse starts to unfold in the next year. So let me share a story with you I saw this morning out of Bloomberg, and it feeds on a lot of what we've been discussing over the past couple of weeks about how this private credit stuff is starting to come to light, the NDFI stuff, right? We talked about, yesterday's show with, putting the interest on the back of the loans, reworking the loans, extend and pretend, shadow banking, shadow default rate. So out of Bloomberg, it says, as Halloween monsters of all stripes flood neighborhoods. Well, the title of the article, by the way, is "The Ranks of Corporate Zombies Are Growing Credit Weekly," and that's from yesterday. So it's Halloween monsters of all stripes flood neighborhoods in search of candy and parties this weekend. Credit markets are seeing the resurgence of a different kind of zombie. The tally of zombie companies in the United States that aren't earning enough to cover their interest expenses stands at the highest since early 2022, with almost 100 zombie companies gaining the designation just in October alone. The main reason: companies that gorged on debt at near zero interest rates in the pandemic era have since been hurt by tariffs and higher funding costs. Says the odds of getting, we discussed this yesterday, where the silver lining, Main Street is saying, yeah, but it's no big deal because rates are coming down. Here's why it's a big deal. And it's a total misleading, let's say, theory, or let's say statement that these companies are seriously going to be able to refinance all this trillions of dollars of debt. The odds of getting much relief on either front aren't improving, with the U.S. signing trade deals and lock in some of the higher tariffs, and the Federal Reserve signaling that it might not continue to cut rates at its December meeting. Zombies will have to take steps to fix their balance sheets, such as boosting earnings or arranging new costly financing, or potentially face default. They're already in default. They're in default from these loan reworks where they're already stacking the interest on the back of the loan and amending the loan agreements, okay? So do you think they're going to be able to refinance if they're going from 3-4% into a 6-7-8% loan on millions or trillions of dollars cumulatively? Heck no. Okay, and we know they're not going to boost their earnings. They're not making enough now. If they couldn't make enough to pay the interest when they borrowed at 0, 1, 2%, how are they going to do it now? It says it won't be easy, even if the Fed were to continue with cuts. The borrowing costs for small companies, zombie companies, are still multiples higher than historic averages. That's according to Liz Saunders, chief investment strategist at Charles Schwab. A lot of these companies were barely scraping by at zero rates. I pulled something up this morning, there's something like 2,000 publicly traded zombie companies, okay, by that definition, right now existing in the United States. And we just, publicly traded. But we don't know. What you can't access, and I've tried, is what is the amount of debt held. It is somewhere, between the, hundreds and hundreds of billions and several trillion dollars, okay? Many of these companies that slid into zombie status in October were in healthcare and biotech. The sector has been under pressure amid soaring costs and shrinking federal subsidies. Okay, and of course, other types of companies, it says, are exposed to tariffs were added to the list also. But it says many of the companies have been on the list for some time. Among the corporate zombies in the U.S. were film producer Lionsgate Studios, Tronox Holdings, Altus USA's, CSC Holdings, and they go through to talk about some of the companies that have now been added to this zombie list. Some companies are in trouble because they're carrying heavy debts tied to leveraged buyouts that made more sense years ago. These balance sheets were structured when rates were low, and they don't necessarily work when rates are high, said David Rosenberg, head of liquid performing credit at Oak Tree Capital Management. To be clear, the designation isn't necessarily a death sentence. unlike the Walking Dead on the silver screen, these zombies can come back to life. Companies can cut costs, sell off pieces of themselves, issue equity, or renegotiate, it says, their debts. But again, their operating income is less, okay, than their interest expenses, okay? So if the coverage ratio falls below 1, it signals to lenders that, so let me back up. So this is a related measure. The interest coverage ratio compares earnings before interest, tax, depreciation, and amortization with interest payments. And if that coverage ratio falls below 1, it signals to lenders that a company isn't earning enough to carry its debt. In some cases, this can violate terms of a zombie's loans or bonds. In severe scenarios, a creditor can impose even more costly terms or demand immediate repayment. Okay, and then if you have eroding coverage, okay, so it worries me when I see interest coverage below 1, said Shannon Ward, a fixed income portfolio manager at Capital One. Companies that borrowed in the high yield market or loan market likely used adjusted EBITDA, which tends to be more optimistic, and in some cases, their growth and cost projections just haven't panned out. So basically, they BS the whole thing to get the loan in the first place. They made their books and their revenues look better. They now have these massive loans they cannot pay. And what they're saying is we're going to start seeing it's going to be an uphill battle. Getting financing is going to be very difficult. And it says S&P Global Ratings has already lowered its earnings forecast for speculative grade corporate issuers for this year and the next, according to the report published in October. Okay, it says then there's a third problem, maturities. And here we go. How companies are going to address that will be an interesting question. Some companies have all but conceded they can't answer that question unless they get a break from the lenders. Okay, other zombies, it says, are still lurking. According to Carolyn Alford, partner with the law firm King and Spalding, there is more distress in the market than participants will admit. So again, this is basically the flip side of the same coin. It's massive debt. And look, we haven't even talked about the collateral. The collateral for these loans, number one, how good is it? Is it quality collateral? Okay. And if these loans start accelerating in mass into this next year, when a lot of these maturities are coming due, what's going to happen if they can't be paid? Okay, what's going to happen is the lenders are going to foreclose whatever collateral they have. If that means real estate, commercial, residential, whatever it is, portfolios, assigned, let's say revenue streams off of, factoring from receivables, whatever it is, all that stuff gets put on the chopping block at a fraction of its value. What does that do to everything? It brings the value of all of these assets down. So guys, button up. Button up the hatches on this and keep tucking it away. We've all heard the term zombie company before, but there's a reason why all this stuff is starting to flood the news stories right now. I'll keep covering it. If you enjoy the content, leave me a like on the video. If you're not subscribed, please subscribe to the channel. And leave your thoughts and comments. Do my best to respond to them. Jumping on a plane here in about an hour. So hopefully for the first few days of this coming week, I'll be able to share some cool content with you from my destination here. So again, I appreciate you guys. Talk to y'all soon. Bye.